Good afternoon. Welcome to MSO's 8th and final webinar of 2024, The Evolution of the BOP by MSO's own Mary Beegle. I am Sue Quimby, Senior Vice President of MSO. Joining me as host is MSO's CEO and President, Jan Seitz. Attendees will be muted. If you have questions or concerns, please enter them in the chat or Q&A window. Review the antitrust compliance policy and discussion guidelines. We will not discuss or answer questions that might address any trade secrets. Next is the disclaimer. Copies of these items are available upon request. We would like to thank our generous sponsors listed on the screen at our website. They help us provide these quality educational webinars, ed seminar, and golf outing. Annual and event sponsorship opportunities are available as well. Contact us for more information. We are pleased to offer at least 8 webinars each year. Next year, we are going to change it up to offer 3 webinars, but all of them will have CE in multiple states. We welcome suggestions for presenters and topics for our webinars. If you missed any previous webinars, they are available for on-demand viewing on our website, www.msmnet.com, and they'll also be available on our YouTube channel at the Mutual Service Office. Please subscribe to the channel. It's free. We will be listing the website, YouTube, and LinkedIn addresses in the chat. Next year's ed seminar is already being planned for November. We welcome suggestions for topics and presenters for these CE sessions. You may have seen our training flyer. We offer CE and non-CE training for member companies, agents, and other industry members. In 2025, our goal is to be licensed as a school in 50 states. We are currently at 32. Contact us for more information. About the webinar. The MSO's business owners policy has become a go-to solution for commercial producers and a favorite of insurer underwriting and claim departments. This bundle of coverage is usually priced below the total of individual components, delivers convenience and protection for a range of business types. In this webinar, Mary Beegle, a lifer of the insurance industry, explores the evolution of this revolutionary product with a fusion of insight, past and present.
All right. Well, thanks everyone for joining today for this final presentation of MSO's 2024 webinar series. I understand how precious your time is, and especially during holiday schedules. So really glad you could attend today. And a big shout out to Sue and Cricky for getting us filed for CE in multiple states. That's an exciting development. So today we're going to take a little trip through time. First to the past, then we'll spend a little time in the present, and we'll cruise into the future. It is meant to be an interactive experience, so hope you will jump in at any time with questions or comments. We'll try to get to everyone. So pack for a road trip, if you will, with a couple of essentials. This presentation is called The Evolution of BOP. So need to know what Businessowners is. It's commercial insurance that combines several coverages into a single policy. So it's a package of protections commonly needed to safeguard businesses. And a quick Google search tells us that evolution is the gradual development of something, especially from a simple to a more complex form. So doesn't that sound like where we're headed today? Now, I did not invent the business owners policy, and I do not know everything about it. But I have been at this insurance thing for a long time. I actually started in 1980, and I'm employed by MSO, who was an early leader in the development of the BOP concept. And plus, I had the good fortune to come on board with MSO at just the right time to be involved with their latest revitalization of policy forms and manual. So that's my credentials. But why does history matter? So why spend time looking at the evolution of BOP when we could jump right into what it does today? Well, I'd like to do a very brief but fun little exercise to illustrate that. So this isn't an official poll question. You don't have to answer it, but I hope you'll play along. So in chat, just close your eyes for a moment and think about a car that you really like. Any kind of a car at all that you hold near and dear. Could be the Volkswagen bus that you and your hippie friends went to Woodstock in, or maybe the car that you scrimped and saved to buy on your own, or just a nice model you saw, once on a showroom floor or in a parade. Doesn't matter. Just drop it in chat, and while you do that, I'll tell you mine. So I grew up in a Mopar family, and I'm old, so I'm kind of partial to American Muscle, the birds and the bees. I might pick, say, a 1970 Dodge Super Bee, and those wild Mopar colors. How about plum crazy purple? So your answers are rolling in. I see a Ford Mustang. All right, a Chevy Vega. There's got to be a story there. Plymouth Barracuda. Chevy Corvette. All right, Mark, didn't know you had it in you. Mustang, Pontiac. These are all great cars and great answers, by the way. And clearly, cars that are important to you, that are important to some memory. All right, a T-Bird. But if you were going on a cross-country trip tomorrow, is this the car you want to drive? Now, maybe, but when you put your key in the ignition, and based on what I'm seeing here in chat, most of these would have had a key, maybe another key for the trunk. Would it have started? Would you have got the or the dreaded click, click, click that means you need a new mechanical starter? Would you have been comfortable cranking down windows? If you had air conditioning, probably full blast or barely noticeable. That was usually our two settings. Likewise with heat. And maybe a rough, noisy ride. Safety, something of an afterthought. You probably had a lap belt, keep you from going through the windshield, but probably wouldn't have kept your head off of the dash in an impact accident. So now fast forward to the present time. I just got a new, excuse me, a new Subaru, and I'm so tickled with it because I waited a really long time to get a new car. It's got a smooth, comfortable ride, comfortable seats, lumbar support. The seats are heated and ventilated, climate control in the cabin, kicking Kaplan sound system. And talk about safety features. I mean, it keeps me between the mustard and the mayonnaise. It won't let me tag the car in front of me. I can't back into something without warning. It tells me when a car is coming around me, shakes the steering wheel if I start to fall asleep, warns me if the posted speed limit is changing. So my point is, that's the car I want to take to California tomorrow. As much as I might love my classic Super Bee, but how does this correlate to business owners, to the evolution of the BOP product? Well, I think if you don't understand where the BOP product came from and what it was originally intended for, you can't fully appreciate all the features it has now and what it can do for you in your office, whether you're a company or an agency or some other insurance affiliation. And I think the other important point about understanding the evolution of BOP is that that's necessary for you to see the influence you can have on the future of the business owner's product. How do you influence, maybe you're a claims adjuster or an underwriter or serve in some other role in the insurance business? How do you influence it? Well, you do that with your voice. You speak up to the decision makers in your company, and you share ideas when you're in agency meetings or company association meetings, PIA, PAMIC, NAMIC, NAIC. Talk about what you like about the BOP policy, what you want it to do more of, what you don't like about it. That's how you can influence where this product goes into the future. So we'll get started by putting it in reverse with a little history. Now, you may have heard that insurance started a long time ago with a bunch of merchants in Great Britain talking about how to finance the perils of an ocean voyage. But the first official insurance company formed in England after the Great Fire of London in 1667. Now, that fire started in a bake shop and it flamed for 4 days, gutting the entire city, including about 13,000 homes as well as businesses large and small. Now, Wikipedia tells us that commercial damage from the Great Fire of London included 87 parish churches, including St. Paul's Cathedral, 44 company halls, the Royal Exchange, which is similar to our Wall Street Stock Exchange, the Custom House, that was where the city collected customs duties, Bridewell Palace and other city prisons, the General Letter Office, which is their postal service, and 3 western city gates, Ludgate, Newgate, and Eldersgate, and countless other businesses, including anyone in chat, you know this, at least one bakery. That's where the fire started. So the Great Fire of London left no doubt in anyone's mind that there was need to protect businesses to help them recover from the peril of fire. So though it was not the first insurance company in the United States, Benjamin Franklin founded the Philadelphia Contribution Ship for the insurance of houses from loss by fire. And is it any wonder our industry has resorted to acronyms? But anyway, Ben founded the Philadelphia Contribution Ship in 1752. And it wasn't long after that that they began to insure businesses as well as homes. So those early commercial property contracts were intended to cover a company's tangible assets. Usually that would be a building, contents, from physical perils, namely fire. Now, over time, those early commercial property contracts grew into what we know as the 165-line standard fire policy. And the SFP language remains core to many of the policies that we use today. But over time, perils expanded to include explosion, burst pipes, storms, vandalism, and theft. Now, though maybe it couldn't take out a whole major city the way the Great Fire of London did, claims for liability also had the potential to cause significant financial damage to a business. So our industry came out with a commercial liability contract. Now, commercial liability policies are sometimes called general liability or GL. And they don't have a bunch of fancy perils insured. Instead, the insuring agreement's pretty simple. Might sound something like, we pay for the benefit of insureds up to the applicable limit of liability. Those sums insured become legally liable to pay as damages because of bodily injury or property damage insured in the policy. So basically, if you're a business owner and you buy a GL policy, and you mess up in the course of business, you hurt somebody or damage your property, your GL policy is going to pay. And over time, those commercial liability or GL policies have evolved to include defense cost, which is now an important element of the ultimate claim payout, and some other defined coverages like medical payments, which isn't truly a liability coverage, but rather a goodwill offering meant to circumvent liability, personal injury, advertising injury, things like that. So commercial property and commercial liability were and remain today fine standalone products. But historically, there was a problem getting them together. At that time, insurance companies were only permitted to provide one kind of insurance, and agents could only be licensed to sell one kind of insurance. So in my research, I wasn't able to find out a hard and fast reason for those early governmental regulations. So if you know it, please put it in chat, share it with us. I'd love to hear. But I think it's because with insurance being so new and relatively complex, it was probably believed that you couldn't be an expert in all types of insurance. So regardless, this kind of regulation hung on for a while and applied to commercial property, commercial liability, marine, aircraft, other types of commercial insurance, as well as personal lines. But by the 1950s, the idea of a homeowner's package policy was gaining popularity. And so that necessitated some relaxation in these government regulations. Now, the insurance industry sought to bring some of those benefits of the homeowner's package policy to the commercial realm. And that idea took off in the 1960s. Early entrants into that market had a big advantage. For the first time, a business owner didn't have to have a different insurance company and a different agent for every kind of protection he needed. He could get it all from one site. So the first policy was called a special multi-peril, or SMP. Now, this was a layering of property, liability, crime, boiler machinery, other types of commercial policies into one package, and policies being the pivotal term here. So they were layered into one package or account, usually with a discount applied to the whole account. So the business owner saved some money on all those policies. The SMP still exists today. You may more commonly hear it called, though, a commercial multi-peril, or CMP. So you could think of the SMP and the CMP as the Model Ts of the BOP program we know today. Now we had all the policies in one place, so that was good, but it was still kind of trying to bolt Chrysler parts onto a Ford. And there could be conflicts in policyholder perception, and there could be conflicts in critical policy language. So, for example, say it's 1960 something, and you're buying an SMP for your business. Now, you know that you have coverage, at least for some period of time and to some extent, for a newly acquired location. You know that because when you were buying your policy, you told your agent you were thinking of buying this other business, and he said, don't worry about it. You've got some automatic coverage. Just be sure to report it to me when the deal goes down, and we'll add it to your policy. So you have a fire at this newly acquired location, and your commercial property policy in the SMP pays for the damages. You're very happy about that. But now suppose your neighbor comes over to help you clean up after the fire, has a slip and fall accident, and you discover that the commercial liability policy in that package at that time maybe didn't have provision for newly acquired. That's what I mean by the insured's notion of coverage. Despite an agent presenting the package policy properly, in the insured's mind, there could be a need for more consistency among the policies than did exist. Suppose an exclusion in one of the policies contradicted an exclusion or even a coverage grant in one of the other policies. There could be a vital term defined differently in one policy than another, or differences in conditions among the policies. How about policy period? Maybe the time of day all those policies started wasn't the same, or the coverage territory may not be aligned. A big one, cancellation. Could be very different cancellation provisions among separate policies in a package. So these aftermarket parts kind of led to conflicts in policy language that were considered ambiguities. Now, we know in this business that an ambiguity is policy language that is not easily understood by the average policyholder of average intelligence, or language that can be construed more than one way. So where are ambiguities settled? Shout it out in chat. You know this. Anyone? Bueller? Ambiguities are settled in court. And who do those settlements usually favor? Policyholders. Because exactly, Jim. Because you, as a company, we as rating bureaus, we're meant to know better. It's a unilateral contract. We're picking the language. We're supposed to pick words and phrases that clearly show our intent. So Wikipedia tells us that the first homeowners policy in the United States was introduced in September of 1950. Took a while for us to get something similar for commercial needs. Took till about the 1970s, but by then, rating bureaus and a few large insurers were trying to bring that similar consistency to the commercial market, rather than just piling all those policies on top of one another. So now we had policy language all in one policy but it was still something of a hodgepodge of language cut and pasted from those previous commercial property, commercial liability, and other types of policies. So in the 70s, there could still be some difficulty in interpreting the intent of policy language and some potential for ambiguities. Now, these 1970 model policies were intended for Main Street business. So we throw that term around all the time in insurance, but what does Main Street really mean? Well, I looked to Investopedia for clarity and found a great definition. Investopedia says Main Street is a colloquial term used by economists to refer collectively to America's independent small businesses and historic business districts as part of a local economy. So doesn't that sound like just what you see in this picture? Basically, downtown storefronts. Now, these 1970s BOP policies were priced for low-risk trades with fairly homogeneous property and liability exposures. So that would be small-scale retail, some offices, maybe some light service providers, mom-and-pop shops. But they were not intended so much for manufacturing, processing, wholesale, or food services. Now, bear in mind, in the 1970s, most commercial policies, like those in that S&P package, were spec rated. That just means specifically rated. So if you want to write a commercial policy, you send an inspector. He might work for the company, he might work for a rating bureau like MSO, or he might be an independent inspector, but you send the inspector out. He took a look at the premises and the operations, and he assigned a rate, usually per 100, based on characteristics specific to the exposures he identified in the inspection. Well, what a great way to rate, right? I mean, you can't get a more individualized premium than that, but it's labor intensive, and it can increase the upfront acquisition costs for new business. And if you have an existing book of spec rated business, you periodically have to re-inspect it. So these early BOP programs instituted class rates. Now, a classification plan or class plan is just a listing. At that time, they're usually 1 to 2 pages, but just a simple listing of types of businesses that were eligible for coverage in a program and assigning an average rate to each of those classifications. So where did that average rate come from? Probably from all those spec rated policies that came before. But regardless, we now had class plans. Those 1970s BOP policies had a composite rate. So like homeowners, a single premium was charged for the entire policy, property and liability exposures. Now, one rating bureau in the 70s speculated that 70% of that premium was intended to cover property exposures and 30% for liability exposures in the policy. Now, possibly that wasn't dramatically supported with data, just because we didn't have a lot of data in the 70s. I mean, we had annual statements and maybe some companies reporting statistics on handwritten bordereaux, but we didn't have a lot of data. Nonetheless, that 70-30 or 75-25 theory stuck around, and we're going to talk more about that in a minute. So rating bureaus have now been offering the BOP policy since the 1970s, but they didn't stop working to elevate that concept to a higher level. And that took a lot of analysis. The industry looked at types of protections needed by most small to medium-sized businesses, looked at available industry loss experience. Again, not a ton of data available, but premiums and losses were reported in annual statements. So looked at loss experience. The intent was to arrive at equitable pricing for exposures common to most businesses. And of course, there was a mission critical job of continuing to watch for and close up any conflicts in policy language that could lead to those problematic ambiguities. So kind of a shiny new BOP rolled off the line in the 1980s. And this is often considered to be the first evolution of BOP that truly integrated property and liability language in one policy. So just for fun, here is a sample classification plan from that era. And you can see it's one page, and it clearly illustrates this Main Street eligibility. You see mostly small retail here, some offices, a little bit of light service. I bet you could have got a sweet Pioneer cassette deck and Naugahyde steering wheel cover there at Automobile Accessories No Work. Right? So, you know, the traditional insurance policies have a coverage grant, and then there's exclusions, and then there's exceptions to exclusions that carve out little nooks of additional coverage or specific coverage. Well, just for illustration, about that time, MSO took a slightly different approach, accomplishing basically the same thing, but in keeping with our simplified brand, we instead use supplemental coverages written right into the policy form that clearly state the intended coverage and whether it's inside or outside of policy limits. And there's no sublimits embedded in the policy language. Instead, we brought them all into one place in the declaration supplement. That's just an example of another way of tackling that same intent. So the industry continues to work to bring common elements together into the BOP policy. Well, in the 80s is when you'd start to see, where possible, a single definition applying to the same word in property and liability sections, exclusions common to both property and liability coverages, and common conditions applying to the policy as a whole. Now, it's about the time the industry was also taking a forward-thinking approach, looking at the emerging needs of Main Street businesses. So as an example, in the 1980s, you didn't have to have a computer to run a business. Lots of businesses didn't have computers. They had a cash register and a leather-bound ledger book, probably. But computers were becoming more available, more affordable, more prevalent. So that's about the time we started to see provisions, both coverage and exclusionary, show up in BOP policy language for things like hardware, software, data. Not so much data breach yet. In the 80s, we didn't realize how mean hackers were going to be, but we started to see computer terminology in BOP language. Commercial condominiums were coming into their own in the 80s. So that's when we started to see provisions for condominium associations. And I believe this is about the time we started to see allowance for peak season coverage in the BOP. So, Sue, do we have something to offer here while Mary gets a drink of water? Our first official poll question, you got to answer it if you want CE. You don't have to answer it correctly. What is Mary's favorite car? A 2025 Ford Explorer in agate black metallic, a 1970 Dodge Super Bee in plum crazy purple, or a 1990 Chevrolet Corvette, that would be the one with the hidden headlights, in Victory Red. I'm not seeing the results of the poll, Sue. How are we doing? Oh, sweet. You guys were paying attention. Nice. 75% of you said Dodge Super Bee in plum crazy purple. Good job. So looking back at these early 1970s and 1980s concepts of eligibility and pricing and policy language, you're probably thinking, well, boy, that law policy hasn't changed much in the last 30 or 40 years. But today's BOP policy has a lot of new features. That BOP concept of the 1980s was solid. It was the foundation for an industry segment that in 2023 accounted for over 61 billion in direct written premium, with net written premium up nearly 13% from the prior year. I got those numbers from the Insurance Information Institute. But the policy has continued to evolve since the 80s. And today, for many companies, the BOP is the preferred, the go-to commercial product. And we're going to explore in a moment a little more about why that's the case. But for now, know that Business Owners is no longer for Main Street risks only. That one-page class plan we looked at has exploded. Most Business Owners programs today have hundreds of classifications. So many, in fact, that they are generally categorized, much like you'd see here, maybe contractors, mercantile, office, residential, restaurant, and service. All these classifications would consist of existing classifications, which have been segmented further, and new classifications brought in that weren't formerly eligible for BOP. And in addition, there's room in a BOP program for a company to customize the class plan for additional classifications that might be a special niche or target. So this ends up to be what we call a more granular class plan. And that's a big thing. Can anybody tell me why more granularity in a class plan is so important? Anyone? Well, it's because it reduces risk of adverse selection. Now, I'm going to give you an example of adverse selection so you'll remember how important it is. Imagine you want to insure a dry cleaner, but your guy does drop-off business only. He outsources the actual cleaning to another company. But you're using an older class plan that just has one classification for dry cleaner. So what's going to happen unless you offset it with very restrictive underwriting? What are you going to end up with? Going to end up with a book of high risk, underpriced business. Your guy, your drop-off only dry cleaner, is going to get charged the same rate as the guy he outsources to, the guy who has the hazardous chemicals, the dangerous operations, and who runs the risk of actually damaging the customer's property. So wouldn't take long then for those full operation dry cleaners to find out they can get a great rate with you, and for your drop-off only customer to go to your competition who has a more granular class plan that recognizes lower risk of drop-off only business and rewards that with a better rate. So that's why fighting adverse selection is so important. Whoops, I went too far. But today, most commercial risks, other than, say, manufacturing and auto sales, which have some very specialized insurance needs, a BOP program can accommodate most commercial risks if you choose to write them. So what else has changed about business owners' policies? Well, the way we rate has changed a lot. Remember that composite rate based on a kind of ephemeral 70-30 rule? Well, that's gone. Modern BOP programs typically rate property separate from liability, and maybe even more granular than that, may rate buildings separate from content, separate from liabilities. So that fine-tunes the premium to the actual coverage and perils and limits for that coverage section in the policy. That further reduces your openings for adverse selection. Now, if you report stats in a way that aligns with that more precise method of rating, you've got the coverages in your basic policy mapped back to the correct coverage part, and you've got optional coverages, which could be things like higher limits or endorsement coverages mapped back to the correct coverage part for both premium and losses. So you're going to get more accurate premium and loss data, And that's the kind of data that is vital to monitoring your book of business, the performance of it. And it's vital to developing rate indications that become approvable price change filings. But wait, there's more. Loss costs. So to oversimplify, insurance premium has two elements: what a company can expect to pay out in claims and what it costs the company to administer a policy. So expected claims experience is based on aggregated industry data. In most cases, companies aren't large enough to have a bunch of claims in any one category that will provide credibility. So with claims, the more information you have, the more credible the data. Company expenses could be things like fixed costs, maybe your brick and mortar establishment or your cost of internet, as well as variable costs. This might be salaries, cost of reinsurance, commissions. So in 1945, an antitrust law was passed called the McCarran-Ferguson Act. McCarran-Ferguson granted oversight of insurance to the individual states, took it out of the federal government, gave it to the states. Now, there are many facets to the McCarran-Ferguson Act, but for this discussion, I will quote the Insurance Information Institute. McCarran-Ferguson allows insurers to pool, that's P-O-O-L, historic loss information to project future losses. However, it explicitly prohibits insurers from conspiring to fix prices or otherwise restrict competition, and it subjects insurers to rate-informed regulation in every state. So in the past, insurance departments allowed rating bureaus to provide, whoops, we got another poll question. All right. So in the past, state insurance departments allowed rating bureaus to provide rates. So we used industry averages for company expenses. And that like all P&C number from the annual statements, and allowed some reasonable margin of profit. Even as late as the 1980s, about 20 state insurance departments did not have staff actuaries. They didn't conduct real sophisticated filing analysis. They trusted rating bureau methodology. That all changed in the 1980s. The market started to tighten, and in this wave of consumerism driven by rising rates and reduced availability, the McCarran-Ferguson Act was revisited from that price fixing perspective. That prohibits insurers from conspiring to fix prices thing. So it was determined at that time that rating bureaus could no longer provide the expense and profit portion of rate making. They could only provide the loss portion or loss cost. So existing rate programs were grandfathered, and some still exist today. But new programs going forward had to be filed on a loss cost basis. That meant that adopting companies like you had to calculate and file unique loss cost multiplier. Now, LCM development could be a whole separate webinar, which I would not be qualified to teach. But basically, it is a formula-driven approach to estimating company expenses and expected profit. So the rating bureau provides the loss costs. The company develops an LCM, multiplies it by the loss cost. That arrives at a rate. The rate is then multiplied by an exposure base, such as per thousand of coverage, to arrive at a premium. Now, the NAIC developed a model loss cost multiplier worksheet, and some states have their own version of that, but they're very similar. And it's a pretty straightforward worksheet to make those calculations, but it can initially be intimidating for a company that's new to loss costs. And it does require some understanding of your annual statement, where to find the expense numbers that you need. And it requires some thoughtful decision making, particularly in that profit area. So it was easier for a company to simply adopt a rating bureau's rate program. And then if you wanted the rate to be a little higher or a little lower, file for a deviation. It was easier. It wasn't necessarily better. So I'm going to encourage you to embrace loss cost rating for a couple of reasons. First and foremost, that you don't have any choice. That's just the way it's done now. We have to use loss costs. But maybe just as importantly, because loss cost rating has the potential to level the playing field between large and small insurers. So a company can file a single LCM for a program, or as many as they'd like, based on pretty much any rating distinction, so long as you can either back it up with data, support it that way, or use strong enough rationale. For example, if you're new to the BOP program or you're going into a new area. So this can allow you to price very competitively where you want to be in a desired market. It can also allow you to price intentionally less competitively in an area where you don't want to be underpriced. So this makes it ideal. Loss cost rating is great for entering a new market. Say you are a single state writer and you're only writing in a region of the state, but you want to expand into the rest of the state. Or you're a single state writer and you want to add more states. Or you already write a BOP program, but you want to bring in new classifications that you hadn't written in the past. Well, you'd want to do that conservatively, cautiously, and not in the first year end up with a giant book of business that's out of control. The loss cost multiplier development process can also be a great exercise in accurately pricing your existing book of business. And it can be kind of eye-opening. In my experience, companies, of course, know whether they're operating profitably or not. And they usually know what lines of business are driving their profit or lack thereof. But when you start drilling down into expenses and expected profit, maybe at the classification level, it can really be interesting. It can show you where you need to apply more focus. So there are areas in the loss cost development process with wiggle room. So we have a poll question here. So there are areas in the loss cost development process with wiggle room, and that can recognize things that you do better in your company. So let's say you invest a lot in upfront underwriting. Maybe you do all those inspections before you write a piece of new business. Maybe you have an underwriter review every application. Maybe you use satellite imagery to take a look at the risk. So you could expect that your loss costs might be different than those industry average loss costs. There's a place in the development process to recognize that. And that could make you more competitive where you want to be. Maybe you do a great job of controlling your back office operations. You've got all kinds of efficiencies there. You've invested in a great computer system with straight through processing. Your underwriters don't have to touch very many new applications. Recognize that in your pricing through loss cost development. On the flip side, maybe you're a great big company who doesn't use the agency sales model, instead sells online, and you've got efficiencies of scale. That can show up in your rates through the loss cost multiplier. As a product analyst, I got to say that my favorite aspect of it is that once you have an LCM established, you can affect a rate change by changing one number. So remember all those pages of rate tables that we had to change and check every time we wanted to adjust rates? Well, loss cost multipliers, and the loss cost rating process makes that much easier. All right, so we have the results of our second poll. What are the basic components of premium? Expected claims, company expenses and profit margin, loss costs and loss cost multiplier, or basic coverage and optional coverages. Now, I didn't intend for this to be a trick question, but it kind of is. I intended for the first answer to be correct, expected claims, company expenses and profit margin. But based on what we just talked about, isn't that the same thing as number two? So if you answered one or two, absolutely correct. And if you answered three, keep listening. We'll talk about it some more. So we talked about the class plan exploding from a single page into hundreds of classifications. As that class plan grew, so did the need for optional coverages. Now, many modifications to the policy can be made right on your declarations page. If it's a coverage that's written into the policy form itself, you can modify many of those by showing a different limit or maybe a special deductible on your deck page. Now, rating bureaus don't provide a declarations page for you. You have to produce that from your policy management system. And as a side note, most states require that you file those. But you can change things that are already in the policy that way. But if you want to add new coverages or new exclusions, things that aren't in the base policy language, then you'd bring those in by endorsement. Now, there are countless endorsements for business owners programs. I didn't even try to put a number to that. But there are classics like additional insured and classics like the blanket additional insured. But there are also additional insured endorsements that are very specific to certain industries, certain types of businesses. There are also newer endorsements in today's BOP programs. You'll find things addressed, again, both on the coverage and exclusionary side for drones, green upgrades, data breach, cyber events, sexual misconduct, many other like trending concerns of businesses. Now, we talked a little bit about flexibility in a class plan, how a company can insert new classifications for their specific niche or target. You can also take classifications out of a rating bureau's class plan. You may want to adopt a rating bureau's BOP program, but not all of the rules. You don't want to offer everything that's in that manual. You can take rating bureau rules out. You can insert rating bureau rule, or excuse me, you can insert company specific rules into the manual. Now, I wouldn't necessarily recommend it, but you can incorporate some underwriting and eligibility criteria into your rules. This was more important in the past. You maybe had an underwriting guide and a rating manual. And say you offer coverage, but you have a lot of underwriting guidelines around when you'll offer a certain endorsement or increased limits or something. Your agent would have had to look at his underwriting guide and look at the manual and match up those things to know what he was permitted to sell. Most agents don't use paper manuals anymore. You probably have them quote through an electronic system that guides them along the way. And the danger in that is that every state doesn't require that you file an underwriting guide. So why show them something they don't need to see? And the other risk is that you could change your underwriting guidelines and neglect to change the rule in the manual. But it's good to know that that's a way you can customize your BOP program if you choose to. The other interesting part about BOP programs is that they can involve some hybrid rating. So we talked about, you have a loss cost and a loss cost multiplier, and that determines a rate, and then the rate times exposure base determines a premium. You can tack on some premium after that. And where you would use this is, say you have a bolt-on program. Maybe you've got cyber or service line coverage or equipment breakdown, something that's prescribed by your reinsurer. They give you the language that goes in the endorsement, and they tell you what premium to charge. There is a mathematical way to back into that premium to turn it into a loss cost. But to simplify it, you can simply add that into the premium after application of your loss cost multiplier. So now you're probably thinking, wow, after she told me all that, I see how much the BOP policy has changed in the last 30 or 40 years. But I wonder why it changed so much. What caused all this evolution? Well, you did. Industry users liked the product, needed it to do more. So think about that classic car you noted in chat at the beginning of our discussion. Clearly, you love that car. But maybe now you want it to be a more comfortable, safer ride. That's kind of where BOP has gone. So in our experience as a rating bureau here at MSO, we know that underwriters tell us BOP is a time saver because most risks fit. There is reduced need to evaluate eligibility of commercial applicants for multiple programs. You don't have to slot it into the right program. You know, it's going to fit in BOP. Claims adjusters say they like it because they can get familiar with one set of policy language and forms and feel comfortable making efficient coverage decisions. So you know that in claims, it's all about getting those claims closed fast. I'm not a programmer, but I've looked at a number of different business owners programs. And I can tell you that I haven't seen anything terribly unusual about the rating algorithms. They seem compatible with most popular policy management platforms. And on the sales front, producers like BOP, even new ones, even new producers, because they can learn it easily. It looks and feels so much like a homeowner's policy that we're all familiar with. We all bought homeowners insurance. And I think that that similarity to homeowners and that simplicity in the design of a BOP makes it easier to sell to clients. So is the business owner's policy right for every circumstance? Well, some of you might remember the promise of an amphibious car. In the 1960s, they told us we were going to get this amphibious car that was going to serve all our needs, land and sea. Well, it just didn't happen. Sometimes you just need a boat. I have not seen the insurance industry come up with one product that serves every need. I doubt that that'll happen in my lifetime. But BOP has evolved. It's evolved to fill a big need for a lot of companies. And that's because it provides the ability to acquire, price, and retain business, a large variety of business, and to do that profitably. Now, business owners' policies play well with other commercial products, but BOP is not a resource for commercial auto or for workers' compensation. A business owner's client might need D&O or E&O coverage. They may need higher liability limits than a BOP program can accommodate. And BOP is not designed for unique risks, for high hazard occupancies from massive square footage or for unusual building materials, maybe like experimental roofing. So if you choose to insure those kind of risks or those limits or offer those coverages, you would need to look outside of a BOP program for that. So is BOP done evolving? Well, it's become such a mainstay of our industry. I don't think so. I think that business owners insurance will continue to grow and change and evolve to meet our needs. I can make some educated guesses about what the future holds for BOP, but first I'd like to hear yours. Go ahead and put in chat where you think BOP is going in the future. Nobody? All right. Well, you're a shy bunch. I'll tell you what mine are going to be. Cyber threats are a real concern. Oh, we have another poll result. Okay, who likes BOP policies? Underwriters, this is a great poll question because there's no wrong answers. Underwriters and claims adjusters, agents and programmers, or all of the above. Good job, everyone. All right, so cyber threats are a real concern, even for small businesses. A January 2024 article in Forbes Advisor said ransomware attacks increased by 93% in 2021. And that's just one kind of cyber attack. The article also says that 88% of small business owners feel vulnerable to a cyber attack. So feel vulnerable. If that isn't a selling opportunity, I don't know what is. But I suspect that reinsurers will require stronger exclusionary language around cyber, which is going to create opportunities for new coverages, maybe optional, with defined limits and conditions. So I think it'll be kind of like how we got our arms around pollution in the 80s, rather than trying to have a blanket way of excluding pollution, liability for pollution. We ended up giving a defined amount of coverage with some conditions. I certainly hope we're past the worst of COVID, but the pandemic did leave us with the realization that modern pathogens are tough. I mean, they resist treatments and they spread fast, and that can leave society hamstrung trying to continue with business as usual. So I see ongoing attention to polishing up virus exclusions and BOP policies and strengthening the parameters for business interruption insurance related to that. Now, new forms of business continue to emerge. So I think we'll continue to see specialty coverages designed specifically to serve niche markets like gig work and micro shops. That would be kiosks, pop-up vendors, mobile services, remote work. Those kind of coverages are going to continue to evolve. There are already some really exciting changes underway in construction technologies. So I see BOP growing to address them better and more specifically. Think about additive manufactured building materials, 3D printed. Connected construction sites. Now, connected construction site is where technology and data connect all of the people and processes and tools involved in making something, a building or a thing. The Internet of Things within buildings. So this would be your smart appliances, your smart systems, and the increasing role of robotics and automation in construction and manufacturing. All these things are a double-edged sword. While they have the potential to make us safer buildings and contents, more fire resistive, more wind resistive, more warning if there's a problem, they also impact the insurable values of properties, both up and down, could be more economical or more expensive, and the ultimate claim costs. So this whole slide, this is speculation. These are just Mary's ideas of where BOP is going into the future. But I want to leave you with one closing thought that is not speculation. It's something you can count on. That rating bureaus like MSO and the others, we are listening to what you need from the business owner's product. We're listening to what you want to do more of, what you don't like about it, and we're proactively modernizing the business owner's product to keep pace with demand. So last chance for questions. Anyone have questions for me? Then I would thank you again for taking this ride with MSO. I would love to hear more from you. If you have other ideas about business owners, you can reach me at this email address or this phone number. And Jan, Sue, I'll turn it back to you.
And I'm starting and Sue's taking it. Mary, that was excellent. Thank you so much. And love it because BOP is really such an important product and it is evolving. I thought that really was a great way to position it. So one of our internal great leaders here, Mary Beegle. So thank you. I know Sue's got a couple comments, so I will end my comments there and thank the attendees and sponsors, of course, for making it possible for us to do all these things. And I would ask all of you to sign up on the YouTube channel. It's really excellent. So Sue, your turn.
Well, thank you again for everyone. Thank you for coming to the webinar. And I'm not going to share this. Trying to share something, but I'm not going to do that because we're late. And our next webinars will be in 2020, early 2025. We'll be announcing the dates very shortly. They'll be on farm, cannabis, and DNO. We are planning to offer 4 CEs for those 3 performance programs. Information on all our programs is available on our website, www.msmnet.com. We have over 200 articles that are available for your use. And we're very busy expanding our continuing education school nationwide. We currently have 32 states, and we're hoping to get it for more. We don't file in all states for all classes, but at this point, we do have a number of classes that are filed in multiple states. Thank you for our sponsors. Thank you, Mary, and thank you everyone for attending. Special thanks to our team who makes this all possible, and please complete the survey that we'll send you. Thank you.